Hello everyone, welcome to Brilliant Bankers. In today's session, we'll be discussing about the financial inclusion in India, unlocking the economic potential of a country. So, what is financial inclusion? Financial inclusion refers to the availability and accessibility of financial services for all individuals and businesses. That is, regardless of their economic status. So, in a country like many other developing countries, there have been significant efforts to promote the financial inclusions in the recent years. The government and the various financial institutions have implemented various initiatives to ensure that a larger proportion of the population has access to the formal financial services. So, some of the key aspects of the financial inclusion in India are the Jandan Yojana, which was launched in 2014. The Pradhan Mantri Jandan Yojana is one of the flagship financial inclusion programs in India. Its principal goal is to provide basic banking services, including a savings account, to all households in the country. So, this initiative has been successful in bringing millions of unbanked individuals into a formal banking system. The payment systems. The government has been actively promoting digital payment systems and the cashless transactions to enhance financial inclusions. Initiatives like the UPI have also made it easier for people to transfer money, pay bills, and also conduct various financial transactions using their smartphones. Different microfinance institutions, the MFIs, they play a crucial role in providing financial services to those who may not have any access to the traditional banking. These MFIs offer small loans, savings, and insurance products to the low income individuals, those who are particularly in the rural area, the small finance banks, and the payments banks. The RBI has introduced a new category of banks known as the small finance bank and also the payments bank. These banks are designed to cater the unbanked and the underbanked population, offering the basic banking services and promoting financial inclusion. Financial literacy programs. Educating the people about financial matters is a key aspect of promoting financial inclusion. So, various government and non government organizations conduct the financial literacy programs to empower these each and every individual to make informed decisions about their finance. The government subsidy programs, that is the DBTs, the direct benefit transfers. These are an initiative aimed at transferring subsidies and benefits directly to the bank accounts of the beneficiaries. This not only reduces the leakages but also encourages individuals to open and actively use a bank account. The rural and the agricultural initiatives. Since a significant portion of India's population is engaged in agriculture, there are specific financial inclusions initiatives that are targeting the rural and the agricultural communities. This includes the agricultural credit, the crop insurance, and also other financial services that are tailored to the needs of rural population. So, what are the significance or what is the significance of financial inclusion? The significance of financial inclusion extends beyond a mere access to financial services. It also plays a crucial role in various aspects of the individual and the societal development. Some of the key points that highlight the significance of financial inclusion are the economic empowerment. How financial inclusion facilitates broader economic participation, that is, enabling individuals and businesses to access their credit, their savings, and other financial services. This in turn contributes to overall economic growth by expanding the pool of the participants in economic activities. By entrepreneurship, their access to the financial services empowers entrepreneurs, especially those in the informal sector, by providing them with the means to start or expand their business. This can also lead to a job creation, increased productivity, and also economic diversification. The social impact. The social impact, it goes beyond the economics, impacting areas such as the education, healthcare, and poverty elevation also, leading to the upliftment of the underprivileged and the marginalized persons. Also by education, financial education has a positive impact on education. Access to formal banking services allows families to save for the education related expenses also by paying school fees digitally and also plan for their children's educational future. It also helps in the healthcare, that is by financial inclusion. It enables better access to healthcare services. Individuals can also use this for formal financial tools to manage the medical expenses, purchase health insurance, and also plan for preventive healthcare measures, thereby improving their overall health outcomes. By poverty elevation, by providing access to financial services, particularly in the form of credit, financial inclusion helps individuals break the cycle of poverty. It also allows them to invest in income generating activities, improving their standard of living over the time. And then comes the government initiatives like the Jandan Yojana. The government commitment for financial inclusion is exemplified by initiatives like the Jandan Yojana. By ensuring that every household has an access to the bank account, the government aims to bring even the most marginalized section of society into the formal financial system by the DBTs, the direct benefit transfers, and also the Digital India program. Financial inclusion aligns with the broader Digital India initiative, promoting the use of digital platforms for financial transactions also. This not only enhance convenience but also contributes to a more transparent and a sorry, transparent and an efficient financial ecosystem. So, in all, we can also summarize that the financial inclusion is a catalyst for economic and social development. It empowers individuals, promotes inclusive growth, and has a ripple effect of various aspects of the society, which includes the education, healthcare, and poverty alleviation. Government initiatives such as Jandan Yojana underscore the commitment to bring a more inclusive and robust financial ecosystem in India. So, what are the barriers for financial inclusion? Barriers, like we can refer it to the obstacles that hinder the individuals and communities from accessing the effectively utilizing the formal financial services. So, some of the key barriers are the geographical challenges, limited physical infrastructure in many remote and rural areas, and the presence of physical bank branches is scarce. This lack of infrastructure makes it challenging for individuals in these areas to access traditional financial services, as they may have to travel long distances to reach a bank. Also, inadequate banking infrastructure, wherein even when a physical bank exists in a rural area, there may be a lack of necessary infrastructure and resources to offer a wide range of financial services, wherein hindering comprehensive financial inclusion efforts. The digital divide of the country. A significant barrier to financial inclusion is the lack of digital literacy among certain populations. Many people, especially in the rural areas or among older demographics, may be unfamiliar with the digital financial services and lack the skills that are needed to navigate on the online platforms. The digital divide, also characterized by the disparities in access to the technology and the internet, is a critical barrier. So, without the access to smartphones, computers, or reliable internet connectivities, individuals are unable to take advantage of the digital banking services, keeping them excluded from the formal financial system. And then comes the informal economy, the cash centric transactions. In many parts of the world, particularly in developing countries like India, cash transactions dominate the economy. The prevalence of cash based transactions and informal financial practices can create barriers to integrating the unbanked into the formal financial sector. Then come the lack of documentation. Informal economic activities often involve transaction without proper documentation also. This lack of financial trail can make challenging for individuals to establish their credit worthiness, which is crucial for accessing formal credit and other financial services. There are also regulatory barriers like the stringent identification requirements, the cultural and social factors wherein the trust issues come in. In certain communities, there may be a lack of trust in formal financial institutions, leading people to prefer informal methods of saving and borrowing. That is, building trust is a crucial for encouraging individuals to transition and to form a formal financial channel. Also, the case of the gender disparity. Cultural norms and gender based discrimination can create barriers for women in accessing the financial services. Women may face additional hurdles in terms of social acceptance, control over finance, and also the access to the education that can contribute to the financial exclusion. So, addressing these barriers requires a multifaceted approach involving collaboration between the government, the financial institution, and other stakeholders. Strategies may include the establishment of more accessible banking infrastructure, targeted financial literacy programs, the promotion of digital literacy, and also regulatory reforms to simplify account opening procedures. Coming to the role of technology in financial inclusion. The role of technology in financial inclusion has been transformative, leveraging innovations to overcome traditional barriers and extend formal financial services to the underserved population. So, some of the key aspects highlighting the role of technology is by promoting the digital identity. That is, in the case of the Aadhaar card, the implementation of the digital identity system, such as Aadhaar card or the Aadhaar number as a digital number, in India has played a pivotal role in enhancing the financial inclusion. Aadhaar, which is a biometric based unique identification system, has enabled individuals to establish their identity electronically, reducing the reliance on physical documentation. This has simplified the account opening process and also allowed more people, especially in the rural areas, to access formal financial services. The mobile banking setup. The widespread adoption of the mobile phones, even in remote areas, has become a game changer for the financial inclusion. Mobile banking allows individuals to perform various financial transactions using their phones, such as the account management, fund transfers, and bill payments. Mobile banking services also provide a convenient and cost effective solution, eliminating the need for physical presence of a bank's branch. And also, mobile money platforms have demonstrated the power of leveraging mobile technology to provide financial services. These platforms enable users to store money, make payments, and access credit through their mobile phones, particularly benefiting those without the traditional bank accounts. In India, there is only one such person who that is the Paytm, and all the other payment banks have been restricted from doing so. Even Paytm has been stopped for the. Coming to the fintech innovations, they are tailored for solutions for the underbanked personals. Fintech innovation has been instrumental in addressing the specific needs of the underbanked population. So, fintech companies have developed innovative products and services such as the microfinance applications, peer to peer lending platforms, and also digital wallets, which cater to the individuals, and digital wallets which cater to the individuals with limited access to the traditional banking. Efficient and inclusive solutions, wherein the fintech solution leverage technology to streamline processes, reduce costs, and also reach a wider audience. These innovations often circumvent the need for physical infrastructure, making financial services more accessible to those in remote and the underserved areas. So, in conclusion, on the role of technology in financial inclusion, we can say that technology plays a crucial role in advancing the financial inclusion by addressing key challenges and providing innovative solutions also. So, digital identity systems, mobile banking, and fintech innovations collectively contribute to creating a more inclusive financial ecosystem, empowering the individuals and communities to participate in formal financial channels. So, how does it come or help the economic growth? So, financial inclusion and the economic growth, these are interconnected. With the increased access to the financial services, contributing significantly to the overall development of an economy. The three key ways in which the financial inclusion fosters the economic growth are by microfinance, that is by entrepreneurship and local economic development. Microfinance plays a crucial role in providing small loans, also known as the micro credit, to entrepreneurs and small businesses, particularly those in the informal sector. These funds empower individuals to start or expand small enterprises, contributing to local economic developments. These MFIs often target marginalized and the underserved population, offering them a pathway to financial inclusion and the economic empowerment. The consumer spending with increased access to financial services such as the savings account and credit, this empowers the individuals to manage their finances more efficiently. This in turn leads to higher consumer spending as people have the means to purchase goods and services also. Higher consumer spending stimulates demand in the economy, driving business activities and contributing to the overall economic growth. This also helps in the financial stability by having access to formal financial services that provides individuals with a safety net for emergencies and also future planning in their healthcare and capital development also. The job creation, financially included financially included individuals are always better positioned to explore entrepreneurial opportunities. With access to credits, allow them to start businesses, expand the existing ones, or invest in productive assets. And finally, this entrepreneurial activity contributes to job creation, fostering a more dynamic and resilient labor market. In summary, we can say that the financial inclusion acts as a catalyst for economic growth by empowering individuals, promoting entrepreneurship, stimulating consumer spending, and contributing to job creation. As more people gain access to formal financial services, the overall economic landscape becomes more inclusive, dynamic, and resilient, fostering the sustainable development. Coming to the Indian stack, the digital revolution. The Indian stack, it represents a monumental shift in the digital landscape, transforming the way Indian residents access financial services and participate in the formal economy. From digital ID solutions to the seamless transactions and credit access also. It has created an inclusive, innovative ecosystem that sets a global benchmark for the digital economies. The digital ID and the financial inclusion, especially used by Aadhaar ecosystem in India, has played a pivotal role in advanced financial inclusion. So, digital ID, particularly the Aadhaar system, has impacted the financial inclusion. How? Aadhaar, India's biometric digital identity system, has provided a unique and secure identification to residents across the country. This universal identity is instrumental in bringing previously excluded populations into the formal financial system. However, the individuals who lack traditional form of identification can now access a range of financial services using the Aadhaar card itself, reducing the friction by streamlining the customer onboardings. Aadhaar-based eKYC has streamlined the customer onboarding process for financial services by allowing businesses to verify the identity of the customers electronically using the Aadhaar details. The need for extensive paperwork has been significantly reduced, which has led to a more efficient and seamless account opening processes, particularly benefiting those in the remote and the underserved areas. The biometric authentication. Aadhaar incorporates a biometric feature which has the fingerprint and the iris scan facilities, enhancing the security of digital transactions. So, biometric authentication adds an additional layer of verification, reducing the risk of identity theft and fraud. This has instilled greater confidence in users engaging in the digital financial transaction. So, all in all, the digital ID, the other ecosystem, and the other digital identity systems have been instrumental in advancing the financial inclusions by providing a universal and secure means of identification. The reduction of friction in the customer onboarding process the enhanced ease of access to financial services, and the implementation of the biometric authentication has collectively contributed to making formal financial services more accessible, secure, and also trustworthy for a broader segment of people. Coming to the UPI payments or the Unified Payments Interface, it has been a transformative force in the realm of the digital payments in India, which was developed by the NPCI, the National Payments Corporation of India. It is a real time instant payment system that has revolutionized the way individuals and the business conduct financial transactions. So, some of the key aspects that highlight the significance of UPI are the seamless transactions, wherein it is real time and instant payment. It facilitates seamless and real time transactions, allowing the users to transfer funds instantly between the bank accounts. This has significantly reduced the time and effort that is required for peer to peer transactions, making payments quick and convenient, which is available 24/7, and it is also user friendly. UPI transactions are normally initiated through a user friendly mobile interface, making it accessible to the individuals of varying income levels and educational backgrounds. The simplicity of the process has contributed to the widespread adoption of the UPI across the diverse demographics. Coming to the financial access or the enhanced financial access by bridging the gap between the banked and the unbanked divide. UPI has played a crucial role in bridging the gap between the banked and the unbanked populations. Even individuals without traditional bank account can use UPI enabled mobile apps to conduct digital transactions, bringing them into the formal financial ecosystem. UPI's inclusivity extends to various financial institutions, allowing users to link accounts from different banks to a single UPI ID. This interoperability ensures that the users are not limited by their choice of bank for the promoting the financial access for all. The innovation hub or taking it as a catalyst for innovation. The UPI ecosystem has become a hub for innovation, fostering the development of a wide range of financial products and services. These innovations include digital wallets, the cashback offers, and various other value added services that cater to the diverse need and preferences of the users. Also, encouraging fintech startups. UPI's open architecture has encouraged the growth of fintech startups, spurring innovation in the financial sector. The availability of applications has allowed developers to create and integrate new features seamlessly. Coming to security and convenience in its core, the UPI payments always prioritize security and convenience with robust authentication measures and a user friendly interface that ensures seamless and expedient transactions. So, all in all, UPI has become a cornerstone of India's digital payment landscape, offering a seamless, inclusive, and innovative platform for financial transactions. Its impact extends beyond the basic fund transfers, contributing to the financial access, bridging divides, and also nurturing a vibrant ecosystem of financial products and services. So, what is a digital credit infrastructure? The digital credit infrastructure has significantly transformed the landscape of lending by leveraging technology to enhance access, also mitigate risk, and promote the financial literacy of the public. Some of the key aspects that we can highlight as the importance of the digital credit infrastructure are the credit access by expanding the reach to the underserved population, wherein the digital credit or by providing digital credit, this infrastructure has played a crucial role in expanding the access to credit for individuals and small businesses that were traditionally underserved by the traditional banking systems. By leveraging the alternative data sources such as mobile phone usage, utility payments, and also the transaction history, lenders can access creditworthiness that is beyond the traditional metrics. By also inclusive lending, it has also the potential to reach those who may lack a formal credit history or collateral. The digital credit infrastructure also enables quick and convenient loan processing reducing the time and effort required for loan approvals. This speed is crucial for addressing the immediate financial need of the borrowers. Coming to risk mitigation, digital credit relies on advanced credit scoring models that analyze a variety of data points, providing a more comprehensive assessment of an individual's credit worthiness. This allows the lenders to make more informed decisions, reducing the risk of defaults, which also, with the use of digital platforms for underwriting processes, streamlines the evaluation of loan applications. Automation and algorithm also help access risk factors efficiently, enabling the financial institutions make the decisions faster and to make the faster lending decisions while with accuracy also. It also helps incorporate sophisticated fraud detection mechanisms also, utilizing artificial intelligence and machine learning algorithms to identify and prevent fraudulent activities. With all, we can also add the financial literacy. The digital credit ecosystem emphasizes the financial literacy and education as integral components of its framework. Borrowers are provided with information about the terms and conditions of the loan, interest rates, and the repayment schedules, empowering them to make informed financial decisions. Many digital credit platforms offer educational resources to borrowers, helping them understand the implications of borrowing, managing debt, and also improving the financial well being. This focus on financial literacy contributes to the responsible borrowing and financial inclusion. And finally, we can say that the digital credit infrastructure has not only expanded access to credit but also introduced innovations in the risk management and emphasized financial literacy for the population of India. About empowering the unbanked. What is empowering the unbanked? Inclusive banking solutions have played a vital role in fostering the financial inclusion for unbanked populations, and it has paved the way for community development and economic empowerment. So, what is this inclusive banking solutions? They are instrumental in bringing the financial services to underserved and underbanked populations, fostering financial inclusion and contributing to the community development. Like the microfinance institutions, which we had discussed earlier, which are tailor made and play a crucial role in providing the financial services to individuals and businesses in the underserved communities. It also empowers entrepreneurs, especially women and those in the rural areas, by providing access to small loans for income generating activities. It is not only about financial services but also about creating a positive social impact by reaching the underbanked or the underserved. These MFIs or the microfinance institutions contribute to building local economies, improving the living standards, and promoting sustainable community development. The banking correspondents. Banking correspondents act as intermediaries for formal financial institutions, taking banking services to the remote and inaccessible areas where the physical bank branches are limited. This approach ensures that even those in the rural or the geographically isolated regions can access the basic financial services. They provide basic banking services at the doorstep of the individuals in rural and remote areas, which include activities like account opening, cash deposits and withdrawal, and also facilitating the digital transaction. The use of the banking correspondence has helped in an effective strategy to bridge the gap between the formal financial institutions and the underbanked population also. Finally, coming to the financial literacy program again, it plays a crucial role in enhancing the knowledge and awareness of the individuals regarding the financial matters. By imparting financial literacy, individuals are better equipped to make informed decisions about their finances. It also, the financial literacy program often involves community engagement initiatives which contribute to building a financially aware and empowered community. This in turn supports the adoption of formal financial services and promotes a culture of responsible financial behavior. Now let's have a look onto the policy and the regulatory support of financial inclusion. The policy and the regulatory support are the essential pillars in advanced financial inclusion, creating an environment conducive to the innovation, consumer protection, and the stability of financial system. So the main three aspects of the policy and the regulatory support in context of the financial inclusion are the inclusive policies, wherein the government commit to financial inclusion. The government play a crucial role in shaping the financial inclusion landscape to the inclusive policies. Policies that explicitly support and prioritize the financial inclusion, that create an environment conducive to reaching underserved and underbanked population. By promoting innovation, inclusive policies encourage innovation in financial services, allowing for development of products and solutions that cater to diverse need of the population, which can include policies supporting digital payment systems, microfinance, and other initiatives that bridge gaps in the financial access. Coming to the consumer protection measures, inclusive policies often incorporate measures to protect consumers, ensuring fair and transparent practices by financial institutions. This may involve regulations related to the interest rate fees and disclosure requirements, safeguarding the interests of the vulnerability or vulnerable and marginalized consumers. The regulatory reforms. Regulatory intervention focus on enhancing the customer or the consumer protection by establishing clear guidelines for fair lending practices, transparent fee structures, and effective dispute resolution mechanisms. Regulatory reforms also often aim to foster a competitive environment in the financial sector. This encourages the entry of new players, including fintech firms and microfinance institutions, promoting innovation and expanding the range of financial products. And finally, coming to the public and private partnerships. Collaborative institutions or the collaborative initiatives that are being taken nowadays, the public and the private partnerships are instrumental in accelerating the pace of financial inclusion. Government collaborate with the financial institutions, technology providers, and other stakeholders to implement impactful initiatives that leverage the strength of each sector. Technology integration is a way for public and private partnership, which often focuses on leveraging of technology to improve the accessibility and efficiency of the financial services. Collaborative efforts also enable the scaling of successful financial inclusion programs by combining resources and expertise. Public and private entities can implement initiatives that reach a larger audience and have a more significant impact on improving the financial access. All in all, the policy and regulatory support are crucial elements in the drive of financial inclusion. Inclusive policies, reformatory reforms, or the regulatory reforms, and the public private partnership collectively contribute to create an environment where financial services are more accessible, innovative, and protective of the customer's interest. How do we address the barriers? Addressing barriers to financial inclusion requires targeted efforts aimed at overcoming obstacles and ensuring that all individuals have access to the formal financial system. So let's go to 3 points that are used for addressing the barriers. The last mile connectivity. Improving the last mile connectivity and infrastructure is essential for extending financial services to remote and underserved population. This includes initiatives such as building physical bank branches, installing ATM machines, and expanding the mobile network coverage to the rural areas. Utilizing the agent banking networks can help overcome the challenge of the last mile connectivity by providing banking services through the agents in remote areas. Leveraging mobile technology also can bring the last mile gap by providing access to financial services through the mobile phones. Mobile banking solutions enables the individuals in remote areas to conduct transactions, access the accounts, and even apply for loans using the mobile devices. The digital literacy, which has been discussed even earlier, implementing programs to enhance the digital literacy and awareness is crucial for empowering individuals to utilize the digital financial services effectively. These programs provide training on using the digital platforms, understanding the online security measures, and navigating through the mobile banking applications. Collaborating with the non governmental organizations and the community based organizations can also help reach individuals who may be more isolated or marginalized. These organizations often have been established networks and can facilitate digital literacy training at the grassroots levels also. Coming to the last and the final point, the community engagement. The grassroots community engagement initiatives that play a vital role in building trust and acceptance of formal financial services. Engaging with communities, understanding their needs and concerns, and also involving them in the design and implementation of financial inclusion program fosters a sense of ownership and trust. Identifying and empowering the local champions within the communities can also amplify efforts to promote the financial inclusion. Also, conducting awareness campaigns about the importance of financial inclusion and the benefits of formal financial services can help dispel the myths and the misconceptions. These campaigns can also be conducted through various channels that are including the community meetings, radio broadcasts, and also the social media platforms. In conclusion, addressing barriers to the financial inclusion requires a multifaceted approach again that combines the infrastructure development, digital literacy programs, and community engagement initiatives. By focusing on all these barriers, stakeholders can create a more inclusive financial ecosystem that benefits all members of the society, including those in the remote and the underserved areas of the country. What is the future of financial inclusion? The future holds a significant promise by the ongoing innovation and a commitment to data privacy and security, and also focus on sustainable factors. So how is it going to be done? By innovative solutions. Continued innovation in the financial technology or the fintechs will lead to the development of new and improved solutions for financial inclusion. This includes innovative payment systems, digital lending platforms, and other fintech solutions tailored to the need of the underserved people. The collaboration between the fintech institutions, the governments, and the NGOs or the non-profit organizations will drive the development and adoption of inclusive financial solutions. These partnerships will leverage the strength of each sector to address the complex challenges and expand the access to the financial services. The data privacy and security. Regulators will play a crucial role in establishing and enforcing robust data privacy and security regulations. These frameworks will ensure that the customer data is protected and that the financial transactions are conducted in a secure and transparent manner. Innovations in cybersecurity technologies such as encryption, multi-factor authentication, and fraud detection will help safeguard digital financial transactions against the cyber security threats and also identify the theft easily. The financial literacy programs will include components focused on digital security and privacy, empowering users to protect themselves against potential risk associated with the digital financial services. Coming to sustainable impact, the success of the financial inclusion efforts will be measured not only by the increased access to financial services, but also by a broader society impact. This includes reducing poverty, promoting gender equality, improving healthcare, and also the education outcomes by fostering the economic resilience. Financial inclusion initiatives will increasingly consider environmental sustainability, incorporating of the principles of green finance and promoting responsible investment practices that support environmental conservation or the conservation and climate resilience. Financial institutions and the fintech companies will have to embrace their role as agents of social changing also, aligning their business strategies with the principles of the corporate social responsibility and ethical business practice. So, as a conclusion in the whole lecture, We can say that the future of financial inclusion is promising and is driven by the ongoing innovation and the steadfast commitment to data privacy and security, and a focus on sustainable impact. Advancements in fintech, bolstered by the strong regulatory framework, will continue to expand access to finance services while safeguarding consumer interests, embracing partnerships, and prioritizing social responsibility. That will be key in ensuring the financial inclusion and the efforts that contribute to the broader societal goals. So, by leveraging technology, responsibility, and by fostering collaboration across the sectors, that is, a private and the public partnership, all the stakeholders can work towards bringing a more inclusive and equitable financial ecosystem for all. I hope today's class was valuable. If you have any questions or doubts on this lecture, you may put it up in the comment section. Please do like, share, and subscribe the channel, The Brilliant Bankers. This is Nishan signing off. Jai Hind.